Okay, so mine is to welcome you all. Thank you so much for coming, for joining us. I know it's been a while since we had the monthly reflection, but we are glad that we are here today, and I believe Susan has a lot in store for us. So I would like to speak briefly about GLN. So GLN means Global Leadership Network. It's a network where leaders get to be trained, they get to be monitored, we get to network, to know each other, and also to grow each other, and also to help each other to get to the next level. So we have several courses. Susan was just talking about that before she went offline. We have a course called Impact Leadership Compact. It's a one-day training that is mostly done in churches or for teams, and it entails both training and team building. So it's a very comprehensive course, but it's also a very impactful course. Other than that, we have the Global Masterclass, Global Leadership Masterclass. I think this is our core course, and it's a 3-month course. Normally happens on Tuesdays, Thursdays, and Saturdays. And you can join whichever day you're comfortable with among those three. And you get to learn a lot. You get to go through the manual and also do the weekly book reviews, which are focused to create a reading culture among leaders, because a leader has always to read. So a leader who is not reading will soon lose their voice or their impact. So the next one is strategic leadership. This is a more focused course. It talks about being a strategic leader. This is also a 3-month course, happens on Fridays. Other than that, we have the crisis leadership. These are a slightly new course, because right now it's when we are having the 3rd cohort. And this one is also a 3-month course, specifically focusing on how to handle crisis, be it personal, organizational, or otherwise. So other than those courses, we also have another one called the Emerging Leader. This is focused mostly on emerging leaders, as the name suggests. And mostly we do them in schools, colleges, and universities, and also for young leaders. These are very good course for young leaders. And I believe our president will have an opportunity to take us through those courses at the end of this session. So we are here because of the newest course in GLN, which is the Entrepreneurship Leadership, Strategic Entrepreneurship and Leadership. This is the newest course. We will be starting off the 2nd cohort in August. So, and this right here, this unit, whatever we'll be covering here is part of that course. So it's a very enriching course, and it's also a very hands-on course, because you get to learn the mistakes that entrepreneurs make, those that normally are not really talked about in the normal classroom, business classroom. So I would like to take this opportunity to welcome you all. And I believe that our trainer has a lot for us tonight. So I don't want to take so much time from her. So I would like to take this opportunity to welcome CPA Susan Mungai, who is our facilitator for tonight. As the name suggests, she's a CPA. So I believe she knows what she's talking about when she's talking about finances, financial management in entrepreneurship. So Susan, let me take this opportunity to welcome you. The floor is yours, and we are here to learn. So Susan, thank you.
Thank you very much, Lois, for the introduction. put on my video briefly so that people can put a face to the name. I'm very glad to be here. I'm honored. Thank you for the invitation. And I take this opportunity to welcome all the participants to this session. I would like it to be a very interactive and engaging session. So as we go along, kindly feel free to ask questions and make comments. And kindly, Lois, will you allow me to share my screen so that we can begin without any further delay?
Have you sent the request, Susan? Susan?
Yes. Am I able to, are you seeing my screen? I think
Yeah,
it
we
should
can
be
see the
up.
screen. Yeah.
Oh, okay. All right. So just a minute. I will go off video so that I can minimize. Hoping we will still be together as we go along. So leaders, welcome to the session. This is about financial management for entrepreneurs and basically for everyone really, not just entrepreneurs, but financial management generally. Mostly skewed towards entrepreneurship, but also when you're at your place of work or even in your personal life, these would be very critical money mastery skills that will be very good to learn. So first off, before we even begin, I will pose a question to all the leaders that are participating in this session. Kindly type your responses in the chat. Please tell me what's your biggest financial challenge, whether in your business or your place of work, maybe managing your side hustle, or even your personal life. What is that one biggest financial management challenge that you've come across that maybe has been giving you a lot of trouble? I can check the responses in the chat. We can sample a few. Kindly chat in the post your responses in the chat. The biggest financial challenge. Gladys says it's saving. Susan says sticking to the budget. Pauline, budgeting. Any others? Personal savings. So savings and budgeting, two of the most problematic areas when it comes to financial management. And you know what they say about budgeting? If you do not tell your money where to go, you'll end up wondering where it went. So budgeting is very critical. Savings, yes. All right. So let's begin the session. Emergency management. Identifying a viable project. All right. Thank you guys for your responses. I think all of these are covered in the session that we have ahead of us. So what we will cover in this session is understanding what exactly financial management is and why we need to learn about it, understanding the sources of funding for businesses, overview of key financial statements and ratios, cash flow management, and practical tips for sound financial management. Financial management is a very, very, very broad topic. So in this session, we will cover just some of the critical aspects. And you will have to sign up for the class to learn more. But anyway, we will cover most of the critical aspects, and then you can ask your questions at the end of the session. So the objective for me tonight is to help the participants learn how to manage cash flow effectively, understand core financial statements, explore funding options, and understand some of the key financial metrics that you need. So what is financial management? Financial management, for an entrepreneur, I'll be more skewed towards entrepreneurship. For entrepreneur, you must not only have a vision for your business or for your startup, but you also need to understand how to fund that vision first and sustain that vision. And for you to do that, you need financial management skills. And financial management can be defined as the process of planning, organizing, controlling, and monitoring a company's financial resources so that you can achieve the company's goals. It involves overseeing all financial transactions from cash flow handling to paying expenses, to managing investments, to planning for growth, scaling, ensuring compliance, and generally ensuring longevity of the business all around. Why is it important for us to learn about financial management? It's important so that we can identify how to increase our revenues and reduce our costs and therefore improve our profits. It's important to help us manage growth in a sustainable manner so that you don't grow all at once and find yourself in problems. It also provides data and information to enable us to do proper financial decision making. Financial management also promotes accountability in all aspects. And this will help promote transparency in an organization. It also ensures that there are very few conflicts, if at all, with employees, the business owners. These are the shareholders, customers, suppliers, lenders. If you do proper financial management, you'll find you don't have so many fights with your customers and your suppliers, or even the people who fund your business. So that is the reason why it is important to manage your finances properly. Sources of funding for businesses. When you're starting out, usually before a business starts generating income to sustain itself, you need to get funds from somewhere, one place or the other. For most startups, they get this from personal savings. Others get from family and friends. You can ask your family or your friends to contribute for you. Sometimes they'll advance you soft loans, or sometimes they can gift you the capital. You can also get financing from angel investors or venture capitalists, debt funding that is from microfinance banks or even the mainstream banks, SACCOs, other lending institutions. You can put Shylocks in there somewhere. But before you opt for any specific funding source, it is important for you to understand the control implications and the cost of each. Like, ask yourself, what is the interest rate? How does this compare to another source of funding or another institution instead of maybe a microfinance bank? Can I get a better rate from a SACCO? What stake will the person who's lending me require from me? Are they taking 20% of the control of the company or 30%? Because at first it can seem like they're helping you start out, and then maybe sometime down the line you feel like maybe that arrangement was not optimum. So you need to understand the cost and the control implication. If you are not careful, you can potentially hook yourself up with an expensive cost of capital, and then you find your business struggling to sustain that. So in a nutshell, in brief, those are the sources of funding for businesses. We can have a look at key financial statements that you need to understand. As a business owner or a person who runs somebody's business, or even just generally, you need to understand the key financial, even if you'll not understand them deeply, you need to have an overview of what these financial statements are. So the first one is the statement of profit or loss, which is also called the income statement. And this one shows the profitability of a business. It discloses what revenues were generated in a particular period, maybe a quarter or a month or a year, and it shows the expenses and the profits for that period. The other statement that is critical is a statement of financial position, and this one shows the assets, the liabilities, and equity of a business. Basically, is what you owe, what you own, and what you are owed by people. So it summarizes all that information in one financial statement. Another critical statement is the statement of changes in equity, which shows the capitalization of a business in terms of the shares, whether ordinary shares, preference shares, any classification of shares, and the retained earnings, including any other reserves that have gone into capitalizing that business. And the last critical financial statement is the statement of cash flows, and this one shows the movement of cash in and out of a business. What are the key financial ratios? These will include profitability ratios, which are gross profit margin, net profit margin, earnings before interest, tax, depreciation and amortization margin. And basically this shows how well your business is performing in terms of profitability. What is the return, like the sales that have been made, what percentage of the gross profit, what percentage of the sales is the gross profit or the net profit or the earnings before interest and tax. We also have liquidity ratios, and these include current ratio. Basically, for all liquidity ratios, they measure the ability of a business to cover short-term liabilities. So for the current ratios, it shows how are you able to cover your short-term liabilities using your current assets. Quick ratio shows if you're able to cover your short-term liabilities using assets that are quickly convertible into cash, including accounts receivables, short-term investments, and cash. And the other ratio is the cash ratio. And this one basically is how are you able to cover your short-term liabilities using the cash that you have at hand at the moment. Debt ratios, these include debt to equity ratio. This one shows how much reliance a company has on debt, and it's usually a function of the liabilities, both short-term and long-term liabilities over the equity. The debt ratio, it measures a proportion of assets that has been financed by debt. And interest coverage ratio, which measures a company's ability to meet interest payments on outstanding debts. So there are so many other ratios that are very important to a business operations, and these one are just the main ones. And tracking these ratios is very important to be able to know an organization's financial health is, and also to be able to plan the growth sustainability. At this point, we can have a look at some case studies. First case study is this one, or Wangoi. So Wangoi runs a successful home-based bakery called Koi Bites. Profit of 80,000, mostly from large orders. Despite this, she lacked cash and recently turned down a very lucrative order due to cash constraints. She was not able to finance that order so that she can fulfill it and make the sale. So in a snap, is 80,000 shillings. Cash at the bank at that moment is 8,500 and receivables are 120,000. So the questions from this scenario, what is Wangoi's real problem in this case? What would we say are from this snapshot? Why is she struggling despite being very profitable? We can have some responses. Someone can unmute and suggest the answers, or you can type them in the chat so that we can discuss this scenario.
Debt collection.
Yes, that is one of her problems, debt collection. What is her other problem, or why is she struggling despite her business making not so bad profits? Yeah, too high accounts receivables. So yes, in a nutshell, her main problem is she has a cash flow problem. Her money is tied up in these accounts receivables. Level of cash is low, yes. So her profits are on paper. This is a classic example of a profit-rich, cash-poor trap. So you have very high profits, but in terms of liquidity, you're struggling. And most of her money is is tied up in unpaid customer invoices. So what short and long-term steps could improve her cash flows? So in the short term, yes, her profit margin is less than 30%. Yeah, she has a low profit margin. That is also another problem. So for her to turn around this business, what she would need to do in the short term, she can negotiate quicker turnaround time for customers to pay her. If she's giving her customers maybe 60 days, she can shorten it to 30 or 15 days payment terms. She can request deposits before she fulfills an order. She can ask her clients to pay maybe a 50% deposit or a 30% deposit. And then for the payments that she needs to make, like for purchase of the ingredients, she can delay the payments and try and collect first, then pay her suppliers. For the long-term steps, she could do cash flow forecasting, like try and forecast in the next few months, depending, gauging from the trend in the business. What orders can I expect in the next few months? And then she can plan accordingly on how she will fulfill those orders. She can ask the bank to give her maybe an invoice financing facility that allows her to get the finances, and then when the clients pay, the bank can pay themselves back with, of course, an interest cost. There's an implication there for the interest. And she can maintain a buffer as part of the long-term strategy. Once she collects the receivable, she always makes sure she maintains a reserve that is unused, so that when cash is low, she can always dip into reserve and facilitate other orders. So what debt or line of, would debt help her, do you think? Worsen her situation? And if it would help her, if you think it would help her, why take debt now to finance these orders? Would it be a good move or not a good? What do you guys think? Would it be a wise idea to take out debt? The orders that she gets? Debt is not a good move. Why? Debt would not be a good move. Most participants would be of the opinion that debt will not be a good move. Pauline says it will just add salt to injury. Debt is good provided she's able to honor when the obligation is due. Okay, so yes, it can be either good or bad depending on how she manages it. If she gets the debt and she's able to manage it properly, it can help her bridge the liquidity gaps between when her customers pay and when she needs to pay her suppliers. But if she takes the debt and keeps giving these long credit terms to her customers, then it will sink her further, because now the debt will be due, there's interest cost on the debt, and she's not able to service them on time. So it depends. It can be good or bad depending on how she manages it. Good. We can go to the next case study. So this is the second case study. Jaden and Sheila launched a logistics app called Fast Fleet after raising 5 million in seed capital. They spent heavily on offices. These are Gen Zs. They took out an office in Parklands or Upper Hill, very big high-rise office. They employed a full team and a marketing team, and they went out on an all-out campaign on social media, on the mainstream media for advertisement. So 6 months in, they had very low revenue and were nearly out of cash. So in a snapshot, the monthly burn rate is 900,000. This is the amount of cash they need to pay their expenses. The cash remaining, as at now, is 800,000. Revenue is only 30,000 a month. That's what's coming in. And their break-even point is 1.2 million a month for them to just break even. That's what they need. So the questions for this scenario, what mistakes did these two Gen Zs make? Or what mistakes did these guys make? Anyone? You can unmute and respond, or you can chat. You can type in on the chat. Who would want to take a guess? Having a full team for a startup, yes, that's one of the mistakes they did. They spent much on non-revenue assets activities, yes. That's another major problem for them. The initial costs were too high. Yes, all these responses are correct. They overspent before they knew whether their business is going to make money. And then they did not budget. A lot of idle cash. They went running into expensive offices, a full team. There's no indication of market research, correct? They did not do the proper forecasting of what revenues are we expecting and what expenses are we working with. So they are finding themselves in a hole where they are using all the seed capital in expenses before even the business takes off. So burn rate. Burn rate is how much how much cash a business uses in a month. And usually it will determine your survival period. If your burn rate is too high compared to the revenue you're making, it will most likely lead to a failure of that business. So if you are the investor, what would you have advised them to do? Either a prospective investor or you have already advanced them, maybe 1 million out of this 5 million, you have advanced them some funds to start this business. What would you have advised them? If you are an investor here, or just maybe an advisor to them. Downsize, yes. Minimize on expenses and maximize profits. Focused on building an MVP first. Cut down on the overheads, correct. Start slow, do their market research. Yes. All this would have been very, very good advice for these young people. And for the expenses, they could, instead of hiring a full team, they could have just hired the most critical of that team. Conduct market research to find out the viability. Yes, that's also a very important thing that they should have focused on instead of going on a spending spree. They should have conducted market research, cutting down on overheads. Instead of hiring a full team, they just hire the critical. They don't even need to hire per se. They could have outsourced instead of taking on full employment, full employees, substantive employees. They could then track how much revenue is coming in. And as they grow, now they get a full team. They could start small instead of getting a big office, which will come also with other costs of furnishing and all that. They could have just started small. Yes, all those are advices that we could have given them. So from this, we learn from this scenario that you do not start with the expenses side. You start with building the revenue first, and then start incurring the expenses. Once the revenue starts streaming in, you can now expand. You grow generically, not at once. You should always track costs carefully and avoid the temptation to scale prematurely. They were trying to scale without revenues, with seed capital. So that is something that we can learn from this case study. And now with this discussion of the case studies, we can appreciate some of the cash flow management tips, practical tips to manage cash flow. So the first is that cash is king in every business. Cash is the lifeblood of a business. It's actually the lifeline. What can we say? It's the heartbeat of a business. So at any point, a budget is very useful, and it's an important tool to manage finances. You should always project your cash flow needs and plan accordingly. We can have a look at a sample cash flow forecast sheet that can be used. Let me just stop sharing this and share an Excel tool that can be used to track your cash flows. So this is an example of sorry. It's an example of, let me just go back to the Excel. Kindly confirm, Lois, if my screen is up.
Yes, it is.
Okay. So this is for a startup, and it's a cash projection for 3 years. So they're projecting that in the first year, the sales will be around 2.8. It's a very modest business, and they're hoping to get a loan of 80,000, maybe from a financial institution or a soft loan or a SACCO. Then their capital from savings is 100,000. They're expecting other shareholders to pump in funds amounting to 500,000. So total receipts in the first year will be 3.5. So expected cash outflows. So for the purchase of items for sale or whichever nature of costs to make the revenues, they're projecting 1.2 million. Payroll expenses, 784,800. Setup costs to set up the business, 155,000. Bank charges, insurance, interest on loan, because they're getting a loan also. They need to budget for the interest on that loan. Licenses and permits, municipal licenses, permits, and all that. Marketing and business development, 85,000. Office supplies, printing and stationery, professional fees, rent, repairs and maintenance, telephone and postage, traveling and accommodation, utilities. So in the first year, they don't expect to turn much of a profit, so they do not budget for any tax, and their costs come to 2.8. Then other cash outflows that they expect is that they will pay a portion of that loan, the principal part, and then the other loans, maybe to the soft loans they would have gotten or to the shareholders. They also project cash outflows in the first year. And now they need to purchase items like computers, furniture, fixed assets, basically. So they budget for 384,000 and the software, 80,000. So at the end of the first year, they're remaining with 100. They project to remain with 127,000 in cash, which is what they'll bring into the next year as the opening cash. Now they make sales and they are projecting sales will grow. So that cash plus the sales now will take care of the expenses for the second year. Same process, cash inflows, cash expenditure, closing cash equivalents gets into the next year and the projected sales cost for that year. And now that year they turn a profit and they budget for a tax expense for that year. So when you're making a cash flow projection or basically a budget, there's some assumptions that you need to work with. And some of these assumptions can be like the loan you're taking it to do what? Maybe to purchase the assets, the fixed assets or the software. Are you going to pay this loan monthly or quarterly? What is the interest rate? You need to put that in your notes so that it's always clear to you. And in case you're using this to get financing from a financial institution or from a lender, these assumptions are very crucial for them to make the decision whether to fund you or not. So principal loan repayment is shown separately from interest and expense. Sales are projected to increase by 35% in 2026 and 40% in 2027. Payroll expenses will go up slightly over the years due to salary increments and hire of additional employees. Operating expenses will grow at an average rate of between 7 and 10%. So this is just an example. You can have many other notes and other assumptions depending now on your business, the type and nature of the activities of the business, and your business model. So it's just an example of how you can use a simple Excel tool to track your cash inflows and cash outflows so that you don't get surprises. Like at some point down the line, you have purchased assets and you're wondering, now you have to insure them. You had not factored in an insurance cost in your projections. Maybe you are low on funds. Yeah, so a budget or a cash flow projection helps you to track, to keep in mind all that. So I don't know whether you have any question on this or we can just complete the session and then questions can come at the end. So having appreciated a simple Excel tool, you can go back to the presentation. Just a minute. Let me share my screen once more. So yeah, so we've said cash is king, and you should always forecast your cash needs, the funds coming in and the funds going out. Another thing you really need to keep in mind is invoicing. Mostly for small businesses or small organizations or startups or side hustles, you find yourself, you have so much to do and very little time to do it in. So sometimes you do deliveries or you sell goods or services and you don't invoice immediately. So like 2 weeks down the line is when you remember, oh, I sold it to so and so. I have not invoiced them. I have not collected those funds. So you see, you are servicing other orders, but the funds you should have collected from previously delivered items you have not collected. So you should always invoice promptly. Another issue around invoicing is sometimes you're tempted to reduce the prices. Maybe you're selling to a friend or a relative and they tell you to cut, to reduce the price a bit, and you're tempted to reduce the prices just to keep the customer, or maybe because you're on friendly terms before you check the margins. So sometimes you find you're hurting the business because you're selling maybe at cost or even lower than cost and going at a loss because you made just a spur of the moment decision to lower the cost without having done your margins properly. So make sure you invoice properly and promptly. Then speed up the collection of those receivables. If you have agreed with someone, you are giving them 15 days, you can do a polite reminder when it gets to those 15 days and keep following up. You can even do early payment discounts. You tell someone if you pay earlier before the end of those terms or you pay promptly on delivery, you can get a certain amount of invoice. Just make sure that you can pay with a certain amount of discount. Just make sure that discount does not eat too much into your profits, into your margin. all the terms, when you're selling, all the terms should be clear. Like if it's 15 days or 30 days, make sure it's clear and agreed with the customer. Another thing is to delay payables. Accountants in the house, you're very familiar with this. When you call, when I'm sure everyone here has maybe called someone for their payment and you're told, Mdosi Ayuko, or you're told the check is ready, but it has not been signed. Then you're told, so delay until you find, delay the payables until you collect from your customers and then pay those payables promptly. Another management tactic you can use is to control costs and plan for growth. Do not scale too quickly, like the case they wanted to project this image of growth and like they're a big business before they get to that point. So keep your costs low. Maybe a question I can ask, what's the one thing that you've done either in your place of work or your business or your side hustle that has dramatically cut costs for you? Or even in your personal life, like in your home? What is that one thing that you have done that has cut costs that maybe you can share and maybe help someone in this forum who might be struggling with these revenue leakages, money leakages? Maybe guys can share on what they've ever done, if they've ever done something that they realized it cut their costs dramatically and helped improve their either their profitability for business or their liquidity situation, even at home. Working remotely as much as possible, yes. You reduce on costs for commuting and fuel costs and all that. Movement costs, yes. Collaboration. What's that one thing? I'm sure everyone in the audience has one thing that they do to make sure their costs are kept at a minimum. Someone is asking what is the advantage of delayed payables and its importance. Well, delaying payables is you're buying yourself time so that by the time that payable is due, you have collected on the other side. It's just basically a means of managing your cash flows. If a supplier supplied you and you have 30 days, you can ask them to give you an additional maybe 10 days. And then within those 10 days, you make sure you've collected from your customers to be able to service that so that you don't have to look for funds elsewhere, like maybe from a lender, which might end up being costly. So that's the importance of delaying your payables as much as you can without hurting those relationships. Etienne says, training my team in specific areas that we heavily depend on to minimize hiring externally. That's a good one. So that they can be able to do as much as they can without having to get an outsider. Oppo, you're welcome. What is that one thing that you do? There's a quote that Benjamin Franklin said, that you should beware of little expenses. A small leak will sink a great ship. So those two small costs, they might seem small, but eventually they add up to a lot. So there's a tactic that has been greatly touted by investment advisors out there or people who help persons to plan their personal finances about these transaction costs. I don't know whether you've ever done that exercise of checking your transaction costs maybe in a month and how much it adds up to and how much you could cut down on them. So that's another popular one that people use just to make sure costs are kept at a minimum. So yeah, we can go on. So for growth and scaling, make sure you have a plan. For instance, you can have an investment plan and set aside funds. Then you grow in a generic way. Don't be too quick. Quick and reckless scaling has been known to sink businesses. So you can put funds aside, and once you grow that reserve, now you can expand instead of growing maybe with too much debt and overstretching yourself. The other management item is you can keep accurate records. You should keep accurate records. Make sure you track where your money is coming from and where it's going. All the revenues, the expenses, the capital, the debts, all of it should be well tracked and recorded. Having a gut feeling is not a financial strategy. Small business owners usually say, I know I'm making money, I can feel it. But you should not feel it. You should have records that assure you that indeed you're making money. So keep accurate records, separate business and personal finances. This is also another that entrepreneurs struggle with, especially when they're starting out. They don't have separate bank accounts for the business and for their own personal use. So from the beginning, make sure you separate business funds go to a business account and personal funds go to a personal account. So once, at least every month, pay yourself and use that salary to do your personal expenses. Instead of when you need funds, you draw from the business account, pay yourself a salary that covers all your monthly expenses. That's where also budgeting comes in. Know what your costs are and see whether your business is able to cover that those expenses for you, and do it like consistently. Every month you pay yourself so that you can do your cost from your salary and not from the business. That way you're able to track all the expenses for the business. Avoid unnecessary debt. You should only borrow if it's to increase productivity or to increase capacity for your business. If it's going to earn you a revenue, you can get that debt. For example, getting a machine or an asset that's going to generate revenue or to increase stock that you know will definitely sell. That one you can take the debt and just make sure the interest implications versus what you'll make, it makes sense. If it's not making sense, just avoid debt. Use an accounting software. Consider getting maybe, okay, for small businesses or before you scale, you can use Excel, which is a good tool if used well. And as you scale, you can consider getting a software, maybe like QuickBooks, Zoho, there's Xero. And as you grow even larger, you can get an ERP that is more suited to your now level of growth. Ensure you monitor key performance indicators. You can check on key metrics regularly so that you stay on course. There are numerous KPI trackers